you deserve a reward.
In fact, that reward is 60, 70 in AAA. That's the reward I deserve. I expect to see.
That
in
the name of Jesus.
Amen.
Even myself, I said, God. I realized something about AAA. AAA is like mathematics. It has a formula for every question. For every answer has to be, it's just like case study. Every answer is a case, and it has to be answered with principle.
Exactly.
With principle. Not just any careless answer. There are principles that they've given us already that needs to be used to answer the question. So, and that is what we need to know. And it's not easy to know. You have to climb it. Not be small.
Exactly. Fantastic idea. I like that. And that's the concept. Once you're able to get that principle and the concept, you can attempt any question.
But that one is not easy.
Yeah, it's not. It's not, but then you pick it as we go, as we are practicing, as we are doing the lectures, as we are going back to the videos, through these pocket notes. It will help you decipher the program and what to do. Yeah, that makes a lot of sense. Okay, so we welcome all the new joiners. We have a lot of new joiners on the call. You're all welcome. We may not be able to mention your names one by one because of time, but then we all acknowledge your presence, and you're welcome to the call. I have Julie, my very good colleague, on the call. So others, maybe by the time we get far, we can introduce ourselves, but we don't have much time. So we'll just go straight into the class. Yesterday we looked at first Unit 1 and Unit 2. So today we're continuing with Unit 3. So if you're not speaking, please, I don't mind if you can mute, so that we don't get distracted. So if you're not speaking, please, you can get muted. Thank you. And if you want to interject, please raise up your hand, as is our custom. Julie is like the anchor on that. Once there's an issue or a challenge with any of the slides, she normally asks us to stop and clarify. So if you have an issue, you can just raise your hands, and we'll stop to clarify that. So we're speaking to reporting. And we looked at Unit 1, speaking to the audit report and the meaning of a true and fair view. And Unit 2, we spoke yesterday to the unmodified auditor's report based on International Standards on Auditing 700, 701, and 702. So you could go back to the YouTube videos to check it out. And also, we have pocket notes. So far, or currently, we know we won't be having time to go through the study text of about 537 pages. So right now, exams are 21 days to go. So please make use of the pocket notes. Don't cram any past question, or don't cram any pathfinder. Like Julie said, understand the principle. It could be repeated in another way. Yeah, so understand the concept. When you practice a question, know how to answer it based on the concepts in the case study, in the AAA study text. This is very important. And we have the last two chapters to cover, chapter 14, chapter 15, and chapter 16 today. So please pay our rapt attention. And after the classes, we'll be going through very intensive practice question and answer sessions before the exam day. At least for 5 days, we'll be covering over 10 diets, past questions, 10 diets, to get you prepared before you can now sit down and revise prepare your revision for the exam proper. Okay, so by way of Unit 3, we're looking at audit reporting and the Company and Allied Matters Act of 2020. So we're looking at audit reporting and KAMA. How do they align? How do they marry themselves? So in reporting audit, we have to stay with the guideline of the KAMA 2020. And that's what we are speaking to. So Section 404 speaks to the auditor's report, and members need to examine those reports based on the alignment with KAMA 2020. So whatever auditors do, of course, the IICs are guides, but then the Company and Allied Matters Act are a regulation that protects or guides us in Nigeria. So every audit report must be in alignment with IICs and also the KAMA 2020. So the 5th schedule of KAMA 2020 speaks to matters to be expressed and stated in the report. So for one of them is all necessary information and explanations should be in that report. So the report should not just state the opinion of the auditors, but every other necessary opinion, every other financial or non-financial detail that backs up that opinion based on the sufficient, appropriate evidence obtained during the job must be attached. So KAMA supports that every necessary information or explanations should be added to that report. And number 2, proper books of account kept and adequate returns from branches. So where you have consolidated companies, larger companies that have different branches across the states, across national and transnational or multinationals, proper books of account must be kept across those branches to ensure that they are consolidated. And when the audit report is prepared, that's the basis and part of the evidence they have to prove that they have audited the books, and also the companies have kept proper books of account, and sufficient and appropriate evidence have been provided based on this report the auditors are preparing. So number 3, we have the balance sheet and the profit and loss account agreeing with the books and returns. So KAMA states also, based on the ISAs, that as you are preparing the financial statements based on IFRSs, you are also checking it. Auditors need to check based on ISAs as the guide. The P&L, the balance sheet, which is our SCI, our SFP, and also other books like the cash flow statements must be in alignment, and the books and returns must be properly kept. This is very, very important. Also, statements gives and requires that apologies, I'm a bit distracted. Let me just accept. All right, Aisha. Okay. Aisha is around on the call. All right. So statements on all of those accounts, the statement of comprehensive. You're welcome, Aisha. Nice to have you on the call. You're welcome.
Aisha, good evening.
You're welcome, Aisha. Welcome. Okay. So statements give and require information. They have to be truly and fairly presented in the financial statements, which is one of the cardinal job of the internal auditors or the external auditors also. Our job is to ensure that the financial statement present a true and fair view and with permitted notes to the accounts disclosed. This is key. So we need to be very careful to align KAMA and all this information stated. So in a question, they can ask you that, how do audit reports align with KAMA? So take note, number 1, necessary information and explanations provided in that audit report. Proper books of accounts are kept for the company, whether publicly listed, public interest, and even if it's a medium size or a small company that does not require audits, but they voluntarily submitted themselves for audit, proper books of account must be kept. The SCI, the P&L, and the other books must align and marry. They must balance. Also, statements. Sorry, please, if you're not speaking, can you mute, please? Thank you. Please mute. Thank you. So statements give required information, and a true and fair view is permitted based on the notes to the account. So the notes to the account must tally with the financial information. So for holding companies or group statements, they must show a proper and true and fair view with the subsidiaries, the sub-subsidiaries, the related company, the joint ventures, every associated companies aligned or associated with the group accounts must show a true and fair view. And KAMA is very meticulous about that in this reporting of audits. Also, to the audit committee, that is a cardinal committee for public interest and public listed companies. A separate report from the audit committee must show the form, the nature, and discretionary report speaking to the agreement in the engagement letter. The engagement letter was issued by the audit firm to the audit committee or to the company they are auditing, and the engagement letter must be responded to by the audit committee and management, stating this is the alignment of our job with KAMA 2020. So we need to also satisfy ISA 260 and 265, and it fulfills the fact that reporting based on the audit committee and in alignment with KAMA is very, very complied with in all material aspects. So in auditing and reporting based on KAMA 2020, these are some of the requirements. They are not far-fetched or different so much from the ISAs. It's just that one has to be careful as auditors to ensure that the ISAs are not overflogged or over-concentrated on, and if we forget the KAMA 2020, which is the cardinal law that guides Nigeria in reporting. So in summary of this unit, we need to ensure that KAMA 2020 and the international standards on auditing agree, and most of the time they are in alignment. So in the application and also making it properly provided in the context of the report, we need this to be sure that every material aspect are complied with. So that will be the end of Unit 4 on audit reporting and the Companies and Allied Matters Act 2020. So do we have any question? If you have a question, please speak to that very briefly on Unit 3. Any question? Our new joiners, feel free to ask questions. It's an engaging section. If Julie doesn't understand something, you will see her stop me. So please feel free to do that. Okay, I believe our silence means we comprehensively get to what we just spoke to. So Unit 4, we're looking at the modified auditor's report based on international standards on auditing 705 and 706. So a modified report, like we spoke to an unmodified report yesterday, saying nothing has come to our attention that has materially misstated the financial statement. Unmodified means you didn't tamper with your opinion. Your opinion is intact. The financial statements show a true and fair view. So the financial statements are intact, we don't have an issue. But a modified report is issued when a matter doesn't affect the opinion, and the emphasis on other matters and does not affect the opinion. Looking at a qualified report or an adverse report, you need to discuss first with management that you want to modify the report. So something has come up that needs to affect the report, and that is a modified report. An unmodified report is one that nothing has come up that you need to tamper with the report. So you don't have any material misstatements, financial statements show a true and fair view, and management has done as stated based on the applicable financial framework. But a modified opinion shows that it's issued when a matter has affected the financial statement. And the emphasis is that there's a qualification which shows you have, let's use the word dirty report, because an unqualified report is a clean report. A qualified report is a dirty report showing there are issues, material misstatements, or there's a reason why we are qualifying your audit engagement or audits of your financial statements. Or there's an adverse opinion that shows there are issues, or there's a disclaimer that does not allow us arrive at either a qualified or unqualified opinion. So we need to discuss with management first before we modify the report and tell them the reason why. So essentially, modifying a report speaks to the fact that something is wrong. There's a material misstatement that would affect decision making of stakeholders or shareholders or the owners of the company or the board of directors. So this is very important to understand a modified report. So the emphasis of matter. So Julie, we are here now at where you've been asking of emphasis of matter, and we're coming to matter paragraphs. Yeah.
Okay.
So,
yeah.
Yeah. So
I say 706.
Exactly. So emphasis of matter and other matter paragraphs based on ISA 706 speaks to additional communication and do not modify the opinion without communicating to management. So additional communication do not modify the opinion, but then emphasis on matter draws attention to a fundamental matter that in the financial statements, it is a key audit matter, and your report goes there. Very important. So emphasis on this needs to be taken note by auditors. So any matter that comes up that is material after you've issued your opinion, you need to modify your report, and management needs to be aware. So other matter paragraphs are after your opinion has been stated, maybe speaking to the fact that you did not qualify the report. Then the other paragraph after that matter, the opinion has been stated, you speak to the fact that something has come up to our attention and we need to modify the report. And that's what matter paragraphs speak to. This is very important. So any key issue that comes up goes to this area based on ISA 706. Then other matters are issues that draws our attention or auditors to the matter of financial statements. They are relevant to understanding the audits and the auditor's responsibility and his report. This is very important. So other matters and emphasis on matter paragraphs speaks to an addition, a modification. So take note of that. An addition or a modification that alters your first opinion. This is key. So we're looking at modified opinion, ISA 705. So due to...
Sorry, sir.
Yes, please.
Sorry, sir. I'm a little bit confused because I know that these two items are emphasis on, okay, first of all, my name is Eukaria. This is my first time of joining this class. So I wouldn't say I feel bad, just that I got to know about this group so late. But I know that this particular two items has really been confusing to me. This is my third attempt in AAA, so I really need to write it and get it. So this emphasis on the matter and other matter paragraph, I'm really confused because from what I understand, if you're talking about emphasis on the matter, when there is an item of emphasis of the matter, does it mean that it can be a modified opinion or a qualified opinion, or is it only, does it only come in when there is only a modified opinion?
Okay, thank you very much, Eukaria. Nice to have you on the call. You're welcome. So before I answer your question, Julie is trying to say something. Julie was trying to speak. Julie, please go ahead.
Yes, concerning this matter paragraph, once the emphasis, something has been added to the report, does that mean that to the how did you put? Can you go back to the slides? There was a way any additional communication. Once there's an additional communication to the financial statement, does that mean that financial statement now becomes a modified report?
Thank you very much for that question. So I'll start with Julie's question, then I'll answer Kira's question. So speaking to emphasis of matter or other matters, that means something has come up to your attention. So in partially answering Kira's question, you can see that on the slide there's qualified, adverse, or disclaimer. So qualified means something is wrong materially. So you need to modify the report. Something is wrong. That could lead to qualification or an adverse opinion or a disclaimer of opinion. And that's what matters, emphasis of matter speaks to, or other matters. So something has come up materially. So for example, we've signed the financial statements on 31st March 2025. And that was for January to December 2024. So there's a court case that has been lingering. And when we signed that financial statement 31st, a court case showed that we're supposed to pay a fine or penalty of 1 billion naira to the plaintiff of that company. So that matter that came now, we need the management needs to incorporate that into the financial statements. That's a matter that has come up. So that may not necessarily mean you are qualifying the report, but the financial statement has been altered and management needs to be aware of our opinion based on the 1 billion that has come in. So that may be positive, but there's also the negative aspect where something may come up. That's just an example I use. So in answering your question, yes, when you modify an opinion, something has gone wrong, or something has come to our attention that needs to be adjusted, and our opinion will no longer be the first opinion. So
that means the report will now be a modified report.
Exactly. So it's going to be a modified report, not an unmodified report.
Secondly, another thing too, how can you differentiate between that additional communication with disclosures? Is it the same thing?
Yes, please. It's the same thing. So you need to communicate with management that, okay, this has come to our attention and we need to modify the report. So they need to accept in a representation letter. So everything has to be written. You know, if there's no evidence, there's no document, it's not done. So once they accept, you modify the opinion. If they don't accept, then there's an issue that has to be escalated maybe to the next level of stakeholders.
So that means it's a disclosure. It's a disclosure.
Yes, it's a disclosure,
okay.
Exactly.
Okay.
So you're welcome, Julie. So back to Eukaria. Eukaria said she's a bit confused on the modified report. So it's two ways. Is either there is a qualification issue or an unqualified issue or an adverse opinion or a disclaimer of opinion, depending on the matter that came up. So why we are emphasizing the matter is that something has come up. So it could lead to you qualifying the report or having an adverse opinion or a disclaimer of opinion or not even qualifying the report, depending on its materiality. So that's very important. So any amendment, there is what it leads to the final opinion, and you've modified the report. So don't get yourself confused. Just read in between the lines when a question comes. So what is the matter? Is it very material? And whatever the matter is that has not been resolved by management will now determine your decision whether to qualify the report or to give an adverse opinion or a disclaimer of opinion or any of the or unqualified, leave it as an unqualified report. Did I speak to your question, Eukaria? Are you okay? If you're not okay, please.
You did, but what I'm saying is, if we have, okay, let's assume now we are to audit a company, right? And at the end of the day, it's either we are giving an unmodified report or a modified report. Now, an unmodified report means that everything, the financial statement shows a true and fair view, if I'm correct. Then, yes, but modified report is when you as an auditor, you going through the documents, you got to find out that there are some significant issues that should be addressed.
Exactly. Right.
Okay. Now, what my question is, this emphasis of the matter, is it coming in under modified report, or can it as well come in under unmodified report?
Okay, fantastic. So initially you had a modified report that has a paragraph. You cannot alter that because that has been signed. So in addition to your unmodified report, you now have a paragraph that states this has come to our attention now. I hope that's clear. So this matter has come to our attention and we are adding it to the modified report we stated earlier. Very simple.
That means it can come in any of the forms of the reporting.
Exactly. So under your modified report, you stated that the report is clean. Something has come to your attention. You just continue. So you don't strike and say, no. The first report is null and void. You don't do that in audits. So you go down in the matter or the next paragraph, and that's what it means, emphasis on matter. So the next paragraph is where you state, and you still have to sign it. So there's double signature. After the first report was issued, you sign and stamp with the engagement partner's name and his seal, ICAN seal or maybe ANAM. But the next paragraph, if something comes to your attention, is what speaks to emphasis of matter or other matter paragraphs. You communicate to management, this has come up, so we need to update this report. It's material and we cannot let it go. I hope that resonates with you.
Yeah, thank you, sir.
All right, you're welcome. Okay, so we're speaking to other matters and it draws our attention to a matter not in the financial statements but relevant, and that's what we are speaking to. So the modified opinion is due to material misstatement most of the time or a limitation in scope. So the qualified opinion is, except for material but non-pervasive misstatement or limitation, a qualified report shows that your financial statement has material issues. Adverse opinion speaks to material and pervasive misstatement. The statements do not give a true and fair view. So it's an issue for companies. When you have a qualified report or an adverse opinion, then there's problem for that company. But modifying an opinion necessarily does not mean you have issues. You're just trying to bring to the attention of stakeholders what will affect their decision based on that information. This is very key. So take note of it. Practically, when we are solving questions, practice questions, you see how to apply them under exam condition. There are no issues. I've dealt with the Big Four for some years now in our audits. I'm internal auditor, they are external auditors. So it's very easy to apply this in practice. But under exam condition, it may be tricky, especially if you are not into audits proper. Maybe you are in financial reporting, it may be challenging for you. So the disclaimer of opinion shows there are material issues and pervasive limitation of scope. The auditor cannot even form an opinion whether the report is qualified or not. He doesn't have enough information, speaking to limitation of scope, and whatever is presented is not sufficient enough for him to have evidence to come up with an opinion. And that's what disclaimer of opinion is all about. So pervasive effect speaks to non-confinement to specific elements, representing a substantial portion to the financial statement disclosures. So issues that are not disclosed, that are not clear, maybe financial statement items are not aligning with non-financial information on the financial statements, are pervasive effects. So whatever you say as numbers and you explain as your discursive element should marry. So where you have revenue recognition, for example, IFRS 15, and in the disclosure, the notes to the account, IFRS is saying another thing separately, it has pervasive effect on those financial statements. So auditors read in between the line to ensure that there are no discursive deviations, and also the numbers are not in another direction. They have to marry, they have to be together. So whatever you say in words must tally with the numbers, so it doesn't have any pervasive effect. This is very, very important. So limitations on scope speak to circumstances beyond the entity's control, like the nature and timing of the auditor's work, or the management's imposition of the time and what the auditors should do. And where management refuse to remove a material or pervasive limitation may lead to auditors even resigning from the job or provide a disclaimer of opinion. So it's very important we understand the modification of an auditor's report and what could lead to it very practically. So the form and content of the modified opinion speaks to opinion on the paragraph, the uses of specific wordings, like we've qualified, we have a qualified opinion. This is the basis of our opinion. The paragraph is amended to basis of qualified opinion, and you could explain it in ways that will resonate with your readers. So the form and content depends on the engagement partner and what he's writing to his audience. So in quantifying the impact, if possible, of the modification of the opinion, we need to describe the misstatements, disclose them, what was omitted, and the reasons for the limitation of scope that leads you to having maybe a disclaimer of opinion. So everything must be stated with evidence that this is why you are providing this negative opinion. So you also need to state that sufficient appropriate evidence was obtained for that modified opinion. You can't just modify an opinion. There must be sufficient appropriate evidence. The same way you came up with an unmodified report, a clean report, this was the basis, this was the evidence. And whatever evidence you have to tamper with that report, you also need to come up with that. Except for a disclaimer of opinion where you can't even arrive at a conclusion. You're not saying whether it's unqualified or qualified. You just cannot say. And most times under such situations, instead of issuing a disclaimer of opinion, some auditors resign from the job. They abandon the engagement. They are no longer interested in it because of material issues they have encountered. So this is very important. So for example, speaking to modified opinions, illustration in the study text, there's an illustration in the study text that speaks to you deciding to give a modified opinion, and that can only be justified if management is unwilling to rectify it. So you could meet stubborn management, stubborn directors, you've called their attention to material misstatements, and they refused to attend to it. So you could modify your report and also give a disclaimer of opinion or an adverse opinion or a qualified report based on the materiality of it. So the auditor needs to investigate and consider reasons for management's view and their refusal, also assess the materiality and the pervasiveness and the deviation where possible, also warn management, and also issue the appropriate modified opinion. So there are process You can't just make a decision abruptly. You need to be sure that management is not responding to all your correspondences. This is very important. So the auditor's report and the exam, you should expect exam questions on identifying errors in the report and determining the appropriate opinion for a given scenario. So it's practical. The exams may not ask you to provide an opinion based on a set of financial statements. You're not doing auditing in the exam, but you need to understand what leads to whatever opinion auditors could issue. So take note of this slide. Expect questions on identifying errors in reports and also determine the appropriate opinion to issue for a given scenario. So you also need to consider the true and fair view, materiality, emphasis on matter, whatever matter that has come to your attention that is material. Also going concern on uncertainties. A company is making losses concurrently year in, year out. Could be a going concern red flag. Disagreement with management versus lack of evidence and pervasiveness are what could lead to an exam question that comes in this area. So these are factors that you should take note in the AAA exam situation or scenarios that could be presented. This is very important. So having spoken to the modified auditor's report based on ISA 705 and 706, do we have any questions? We're trying to run. Do we have any questions on Unit 4 so that we can move to Unit 5? Any questions? Julie? Aisha? No, I can see Rufiat is on the call. Rufiat, you're welcome. Nice to have you. I saw her join.
Good evening.
You're welcome. Okay.
Thank you, sir. Good evening, everyone.
You're welcome, Rufiat. Nice to have you. Okay, so let's look at Unit 5, the auditor's responsibility relating to other information, ISA 720. So the auditor's responsibility relating to other information in the financial statements based on International Standards on Auditing 720. So other information speaks to unaudited information in the annual reports like the chairman's statement, director's report, value-added statements, statement of changes in equity, disclosures, and other discussive elements of the financial statements, not numerics now. So ISA 720 speaks to the responsibility to read other information for material inconsistencies with the auditor's statements or the auditor's knowledge. This is very important. So like I spoke earlier, I said the numerical or the numbers must align with the explanations. This is key. And this is where the auditor's responsibility come in. And having privilege to work with the Big Four for a while, they take time to do this. And the next thing you hear is they are calling the internal audit to get on a call or a meeting with process owners to adjust some statements that do not align with the numbers. So if you are saying IFRS 9, we are speaking to expected credit loss. So based on expected credit loss, when you see the receivables in the financial statements and they pass a particular threshold, so if you are using IFRS 9 to provide for expected credit loss, you must marry that information and apply it graphically. So that's just one out of 1,000 examples that the numbers should align with the explanation based on the disclosures and the IFRSs that were used to prepare the financial statements. This is very important. So the auditors need to read and be sure that there are no material inconsistencies. Why? So that when an end user picks that report, maybe on the website or on the Nigerian Stock Exchange, he picks it and he reads it, he should see consistency between the numbers and the explanation. This is very, very important. So they need to also, if auditors find these inconsistencies, they need to discuss with management. So whatever it is, don't escalate before reporting to management. Draw their attention to it for remediation and proper resolution. So the auditor's response first is to ask management to correct misstatements in such areas. If refusal, they need to communicate either with the board or the audit committee. If management refuses, so they need to take it higher to the next step. So if the board management refuses, they may need to disclose to SEC or the Nigerian Stock Exchange or an appropriate authority that will address that. or consider leaving the job or resigning or issue a disclaimer. But then that issue has to be addressed considering its materiality. So if misstatements in financial statements need to be updated, the entity's understanding need to follow ISAs 315, 450, and 560. So these standards help guide us to be able to update the entity with whatever misstatement that has been addressed by management or not addressed by management. So we have standards to guide us appropriately. And reporting on other information speaks to a separate section in the auditor's report, outlining management's responsibility to provide that information and what was read or expected that is not audited, and also the auditor's responsibility on whether there are material inconsistencies or misstatements were found or not. So both have their responsibilities, management and the auditors, in speaking to information or other information in the financial statement. So this is very important to take note of, and practically I believe in solving questions we'll be able to apply this very graphically and see how to answer questions in that area. Okay, so that's it for Unit 5, a very short unit. If you have any questions, please don't forget to raise your hand or interject very, very quickly. Any question on Unit 5? Okay, I don't think we do. All right, so let's go to Unit 6. The impact on the auditor's report of opening balances and comparatives, ISA 510 and 710. We've looked at this unit in a previous class, but then I believe it's a bit elaborate here because it speaks to reporting very graphically. So ISA 510 speaks to initial audits. When you start an audit, you look at opening balances, for example, inventory. You're looking at the opening balance of maybe 2024 of January and comparing it to December 2024. So you are looking at the movements in inventory, for example, just using that as an example. So you report that is modified if insufficient evidence on the opening balances, material misstatements in the opening balances affect the current statement. So one of the things auditors do is to have that cutoff, you must have a stock count to ascertain the opening balance, and also concurrently as month in, month out go. For example, using inventory, the balances are followed through to ensure that those areas, especially a manufacturing company that deals heavily on inventory, IS2 is specially applied, and there are no material misstatements in those inventory that these audits speak to. So inventory is one of it. There are other areas that opening balances must be checked and ensure that they are not affecting current statements. And we have to be sure that inconsistencies in application to policies and also prior year reports that was modified and material issues don't remain the same. So this is very important. So ISA 510 speaks to opening balances and ensuring that they are correct. And there are components and checks to put in place to ensure they are correct. Like the stock count I spoke about is one measure to ascertain that opening balances align with the initial audits and the concurrent audits we are doing. Also for ISA 710, comparative information. We're speaking to opinions that do not refer to comparatives unless a prior year qualified opinion has been resolved. And also it leads to a modified current report that is not qualified or that is clean in our opinion. So ISA 710 compares information, and audits are provided based on opinion that do not refer to comparatives unless we have a prior issue in the last year that has been resolved. So materiality, speaking to prior year misstatements, can lead to an unmodified opinion given that the comparatives not stated and the qualified or adverse issue that affected that last year has been resolved this year. So prior year audit report prepared by a predecessor or a former audit firm that has stated other matters in a paragraph under and an opinion given could be resolved in a new year. So it's not a static thing. Management could sit down and say, okay, these are the issues that are flagged. Let's work on it and resolve it. And in the coming year, since audits are statutory and yearly, they could find out these issues are resolved with appropriate, sufficient evidence. This is key to take note. So prior year unaudited accounts, other matter paragraphs stating that the auditor is still responsible for the opening balances and ensuring that they align with the financial statements, and he has sufficient evidence to back that, speaks to the fact that the impact on the financial statement is what is very important. The materiality and how it affects decision makers and stakeholders of the company is what this speaks to. So that's briefly what ISA 510 opening balances mean, and speaking to initial audits and confirming opening balances and the movements, and also comparatives, ISA 710 speaks to. Okay, so we have 3 more units. Any questions? Sorry, 4 more units. We're trying to run through reporting so that we can go through module 15 today. Any question on the impact of the auditor's report on opening balances and comparatives? Any questions? Please feel free to interject. Okay, thank you, Julie, for that. Okay, so unit 7, the impact of going concern on the auditor's report, ISA 570, going concern. Going concern speaks to the fact that a company will operate in the foreseeable future based on its current position. So the auditor considers implication that will hamper this. The implications of the report, if going concern basis, may not be appropriate, and there are material, he needs to look at that very, very, very critically. So the appropriate use of material uncertainties where they exist is very key. And a company could be bedeviled with issues that affects his going concern. And if it comes to the auditor's attention, he needs to point that out based on ISA 570. And an unmodified opinion speaks to the fact that material uncertainties relating to going concern is a paragraph that has to be stated after the basis of his opinion. So he has stated or had provided a modified opinion, and then something comes to his attention that he needs to modify that unmodified report, and it has to do with material uncertainties speaking to going concern issues. So an attention has been drawn to this going concern matter, and it needs to be stated in the opinion, but initially it was not modified. So going concern issues are material issues, because where companies crash, it could speak to an audit failure. So you're speaking to the fact that you didn't qualify the report, it's unqualified, and in the near future, the company collapses, the auditor is liable, and that's the fear, auditor's liability. The crash of Enrona and WorldCom speaks to that. An auditor was in charge, and he was led liable after the crash of the company. So auditors are very careful to avoid liabilities and responsibilities in the area of speaking to an unqualified report, and something happens in the near future to that company. They'll be like, where are the auditors? What did they audit? So going concern is one of those issues, very, very critically. Also, inadequate disclosure of...
Sorry,
yes.
sir. Sorry.
Yes, please. Yes, please.
Okay, based on the last slide I had, this slide now, the unmodified opinion.
Okay.
To my understanding, you are saying when an auditor issues an unmodified opinion, and maybe at later on he found out that there is a going concern issue, which is significant and material, right?
Yes.
My question is he going to bring it under this emphasis of the matter paragraph, yes, or is he going to, okay, this is where the emphasis of the matter paragraph comes in?
Yes, yes. So you have a modified report initially. A going concern issue has not come to your attention, so you're not going to tamper with that report. It applies to every other issue materially that comes to your attention after the unmodified report. So something has come to your attention now, you need to bring to the attention of the public, stakeholders of the board, as CEO. My initial report stated that nothing is wrong, but now I've discovered that there's a going concern matter. So you need to state it under. So that matter paragraph should be under your unmodified report. That's what this speaks to.
Okay.
Yeah. All right. You're welcome. Okay, so we're looking at inadequate disclosure of material uncertainties that will lead to a qualified or adverse opinion. And a going concern could be one of those issues, because anything that will halt the continuity of a company is a big, very, very big issue. And there are many of them. and you could see it from the financial statements. So when you see it, or matters that came later, the litigation issue that is even requesting them to shut down the company is a going concern matter that needs to be brought to the fore. This is very important. So inadequate disclosure before or after could lead the auditor to qualifying the report or speak to an adverse opinion. And also uncertainties explained in the basis of opinion or basis of issuing the qualified or adverse opinion section, and no separate going concern paragraph could be a reason. So when there's inadequate disclosure and you find out yourself, that could be a reason apart from going concern. So you're doing your audits, you had an engagement letter that management should disclose everything, allow you free access, and disclose whatever it is they know. Maybe that has to do with related party transactions. And in the course of your work, you find some material ones that were not disclosed. That could be a basis for you qualifying the report, considering the materiality and significance. Also, management's reluctance to disclose a persistent and very, very serious display of lack of integrity in front on the part of management is another issue. You could have evidence, sufficient appropriate evidence to qualify their report. So there could be perceived failure, negative impact on the business, employee concerns. The auditor must still modify the opinion that he has provided earlier if disclosure is inadequate. So these are many reasons, including going concerns, that could impact a financial statement. Also, another one is inappropriate use of going concern basis could lead to an adverse opinion. So an unmodified opinion possibly is if an alternative acceptable basis is used with adequate disclosure. Speaking to emphasis on matter may highlight the alternative basis. So an inappropriate use of going concern, if you're not sure that that's where that header falls in, you could use another material header to continue your paragraph under the unmodified opinion. But whatever it is, the matter that comes to the attention of the auditor, please state it. And that's what this is speaking to. State it in the next paragraph. This has come to our attention and we want management to address it. And if they don't, you take it further. This is key. So the impact of going concern and other matters is very important based on ISA 570. Okay, so if we don't have any questions, we're running out of time. Let's move to communicating with those charged with governance, ISA 260, Unit 8, communicating with those charged with governance. How do auditors speak to issues that have arisen or arose during the work to those charged with governance? So formal communication is very important. If it is not documented, it is not done. Verbal communication is not tenable in audits. Everything you do must be supplied with evidence, written or digital signed copies. And that is ISA 260's requirement. So those formally charged with governance, usually directors